Welcome to this special report on WeWork's long overdue bankruptcy. In this video, we will delve into the rise and fall of WeWork, the co-working giant that captivated the business world, only to face financial turmoil and eventually file for bankruptcy. WeWork, founded in 2010 by Adam Neumann and Miguel McKelvey, quickly became a symbol of the sharing economy. The company offered flexible office space solutions in prime locations and garnered substantial investments, reaching a peak valuation of $47 billion. WeWork's rapid expansion was fueled by charismatic leadership and a vision of revolutionizing office culture. They attracted a diverse clientele, from freelancers to Fortune 500 companies seeking modern, amenity-filled workspaces. However, the company's aggressive growth and spending habits began to raise eyebrows. WeWork's financials came under scrutiny as it posted massive losses year after year. The IPO prospectus unveiled alarming governance issues. In 2019, WeWork's attempt to go public ended in a disaster. Valuation plummeted, and the IPO was withdrawn due to a lack of investor confidence in the company's financial health. In 2021, WeWork finally filed for bankruptcy, marking the end of an era. The COVID-19 pandemic had further strained their business model as remote work became the norm. WeWork's bankruptcy serves as a cautionary tale of unchecked ambition and extravagant spending. It's a reminder that even the most promising startups can falter without responsible financial management.
SoftBank was WeWork's largest shareholder, and it pumped well over Having served as CEO and other senior executive positions at Vatrani couldn't have taken the job at a worst possible time. Within a month, the COVID pandemic completely disrupted the entire real estate industry. WeWork was especially hard hit. Because of his desperate financial position, Vatrani wasted little time implementing massive cost cuts. This included. It's important to note that by this point, WeWork's previous financial troubles were well known and extensively covered by the media. Hulu made a full-length documentary about it. Adam Neumann's strange and outrageous antics became something of a meme in pop culture. So it's quite an amazing accomplishment that they could convince new investors to roll the dice again on WeWork, which was still losing more than $1 billion per year. They claimed that since 2020, they had cut close to $2 billion of annual costs. With the pandemic, WeWork was able to negotiate rent reductions from some of its landlords, given the deteriorating health of the office real estate market in general. They cut back on a lot of the freebies, like free beer and drinks for tenants. The main sales pitch was that at its core, WeWork had a profitable business model. The reason they lost money in the past was because of the profligate spending under Adam Neumann. With the new professional management team, they were well on their way to cleaning up the mess that Neumann left behind. They claimed that after their cost cuts, WeWork only needed 70% occupancy to break even. Pre-COVID, they had occupancy well above this level in most of their locations. Occupancy fell to a low of 46% in 2020 due to the pandemic.
I'll tell you what's really compelling about this. It's Barry Sternlicht's quote. I happen to be a big fan of Barry. Way we can get some flexible space. Well, WeWork
with the cost cuts, hybrid work tailwind. In the quarters following the IPO, WeWork seemed to be doing their occupancy increased, so too did their contribution profit. Includes things like rent, the receptionist, maintenance, utilities, while include their corporate level staff such as managers and salespeople. In accounting lingo, these overhead costs are called selling in 75% to 73%. When you start laying off corporate staff, you reduce your costs and your profit increases. But eventually, you lay off so many workers that your ability to function as a company diminishes and your revenue decreases. At some point, the WeWork has reached this point. They had long since laid off all of their unnecessary employees to be one of WeWork's landlords. They have SG&A of about 5% of revenue. The function of a real estate company is leasing out their office space. You need to pay a salesperson or external agent to show the landlord doesn't really have to do anything. They just collect the rent. Flexible short-term spaces. By definition, WeWork must charge a far higher rent per square foot than a traditional landlord.
Thank you for joining us in this exploration of WeWork's long overdue bankruptcy. Stay tuned for more insights into the ever-evolving world of business and finance.